on these issues. So the purpose of my presentation is to present a recent World Bank report on listing state-owned enterprises in emerging and developing economies, lessons learned for 30 years of success and failure, which has been developed jointly with ASEA, Olivier Wyman, and the Ministry of Finance of Luxembourg. And the objective of this report and the presentation is not to make a case for divestiture from SOEs, but really to see how, when that decision has been made, how listing them can be a way to develop capital market, in particular domestic capital market. So my name is Jean Pem. I'm the Global Director for Finance at the World Bank, and this work has been prepared jointly in the context of an initiative with the ILC, which is the private sector arm of the World Bank Group. And we have a joint program on capital market development in emerging market economy. So why do we care? Why do we care about SOE listing? The main objective is private capital mobilization. It will not be possible to reach the SDG, the Sustainable Development Goal, without raising sufficient financing from the private sector. And capital market, and in particular local capital market, are really a crucial tool and element of the collective mobilization on private capital mobilization while maintaining financial stability, and not everything can be bank financing. Now, what do we see in emerging market and developing economy is that overall capital markets remain underdeveloped despite very significant reform. So there's still quite some way to go. And this is why we have that more mobilization. In particular, in Africa, what we see is that the number of listed companies remain stagnant. The public offering have decreased. The participation of domestic and foreign investors is often limited beyond the sovereign. So this is where the question is, can SOE listing be an opportunity to revive capital market growth across Africa and EMDs? And looking at the literature, which is essentially on advanced economy, SOE listing are very often cited as one of the main causes behind the growth of capital market. So we wanted to test a little bit that idea and see whether we have stronger evidence, because one of the challenges of this academic research is that it has not looked enough, in our view, at emerging market economy. So this is the driver and the motivation for this report. So we try to address three questions, which are the ones that you can see on the slide, and obviously focusing a lot on the first question, which is what has been the impact of SOE listing on local capital market development in emerging markets. So again, the objective is not to promote privatization, but really, when the decision is made, how to understand the benefit and the drawbacks of this venture, in particular whether listing can be a viable divestment strategy. And focus on capital market impact only. Due to time constraint, we didn't want to look at everything, but focus on domestic capital market. So the team looked at literature, had also case study analysis of 14 EMDs, and in Africa that covered WAMU, Nigeria, Morocco, Egypt, and South Africa. And we are really grateful for the support from the Bourse de Casablanca and the African Stock Exchange Association that help us conduct this report, but also collect a lot of information. So what do we see in terms of market capitalization? So the short-term impact of SOE listing is really to boost capital market. And the reason is that usually the SOE that have been listed are very large and very well-known company. So to use a couple of examples, in Morocco, the listing of Maroc Telecom has increased market capitalization by around 80%. In Egypt, the largest listing increased market capitalization by almost 100%, and in Nigeria, now nearly 50%. So this is significantly linked to the size of the SOE. And obviously, the effect tends to be larger in early to intermediate stage market. So growth can be higher when the SOE has a gross share of total market capitalization. So one of the examples was Safaricom in Kenya, that represented 60% of total market capitalization. And some example in Morocco, Maroc Telecom, 20% of total market capitalization. So suddenly that SOE become that very important player in the overall market. So what we see is that large listing can also have long-term effect on market capitalization. So you have short-term and long-term effect. And again, it comes back to situation where the OCE listing has been large, above $500 million equivalent. And the reason for that is that large SOE usually divested gradually with multiple listing. We will come back on that a bit later. Also, large SOE listing are sometimes part of a broader divestment program where several SOEs have been listed in seconds. But we also have a couple of examples, not as many as one would have expected, of government that succeeded to create demonstration effect on private companies. So private companies decided to use more capital market funding based on the success of the SOE listing, which is part of that demonstration effect. But what we see on that is that while there is some demonstration effect, it's actually pretty difficult to achieve. And there are quite a bit of conditions to be met before achieving those results. And that's one of the elements where actually our study provides slightly different findings than what you may read sometime in the academic literature. So out of the 14 case studies, the SOE listing encouraged other private companies to list only in Poland, in Singapore, and to some extent in Romania, in Morocco. So that's where that difference come in, and important lessons learned in our view as we think further on how to develop domestic capital market in emerging economies. So 4 main reasons, which you can see on the slide, and four drivers somehow of demonstration effect: a large domestic institutional investor base. The second is good foreign investor access. So both domestic and foreign investor need to be there and support. A pipeline of SOE listings, so one-off doesn't work. A large economy with large private companies, so there's a size effect. And finally, macroeconomic stability as a precondition and kind of economy-wide condition for this to work. So what we see also is that there are adequate level of liquidity, but limited spillover effect when you look at the impact of this listing. One of the reasons we think is that most SOE attract a large and diverse investor base. So that's why you see the liquidity, but you see a limited spillover effect. And the countries where we have seen that spillover effect are the same ones that I just mentioned, where you had that demonstration effect. So again, a connection between the two. But conclusion is that a listing of SOE is not a silver bullet in that respect. So one of the lessons is that SOE listing can attract many retail investors, but that comes with a risk of large sell-off. So this is something that needs to be managed. So the example that you see is Safaricom, where you had 2 million Kenyan that registered an account with the depository, but not all of them could ultimately invest, but still the listing attracted more than 100 investors. But then we saw a runoff. In particular, on first trading day, where very large investor base proved to be quite unstable, in particular when there is an underpricing of the offering. So there are ways to address potential setups, such as distribute share to a diverse investor base, including domestic investors that are more long-term, find buy and hold investor. But still, that's something that therefore needs to be managed, again, from a capital market development. But it's still possible, including when you work with foreign investors. So what we see is that SOE represents roughly 60% of the MSCI Emerging Market Index in energy and 40% in the financial sector. So when the SOE listing comes in a global index, then there are positive effects on stock liquidity. So one of the big challenge and risk when it comes to SOE listing relate to the inadequate market infrastructure. So somehow the fundamentals need to be there for the listing of SOE to bring all the expected results. And that's where we see some variation across countries. And we have a couple of negative examples where actually the lack of market infrastructure has actually not achieved the expected result. And what we see is when there is a weak capital market infrastructure, then government tend to go with a cross-listing or use global depository index, GDRs, as a predominant listing strategy. So there are some benefit of this, which is to successfully absorb large listing, but the potential consequences is that the long-term cost in local capital market, there are long-term costs in local capital market development as the liquidity tends to migrate abroad, and potentially with it, domestic companies and investors also migrate abroad. So there are trade-offs to this kind of approach. And one of the examples is what has happened in Kazakhstan. So again, the best approach is probably to make sure that the domestic capital market infrastructure is strong and accessible to foreign investors, because that provides then a very good platform for connecting the SOE listing with the long-term development. So some elements of precondition or drivers for a successful listing that are coming out of this study. First one is the political commitment, institutional competence, and transparency processes. Really important that there is credibility in order to attract investors and ensure public support to the listing. The second, as already mentioned, an efficient market infrastructure, which means a broker industry well capitalized that can handle large volume, custodians that understand their function as safekeepers, clearing, trading, settlement infrastructure, and very strong accounting and disclosure standard. So that's the whole range of tools to ensure a market infrastructure. Then the good choice of SOEs and preparation. So preparation, very important. So first, identify large profitable companies so that they are attractive, and look also at some capital intensive or technology disrupted sectors as a way to work on this. Because not every SOE can and should be listed, and then requires size and as mentioned, profitability. And what we see is that in many cases that requires the government to first work on the reform of the sector, address the key inefficiencies, restructure the target SOE, and then move to the listing. So there's a sequencing element there that is a very important one. So other elements in terms of impactful listing, what we've seen is to have a pretty strong pipeline and not just one-off, as I already mentioned, multiple offering, stable macroeconomic environment, obviously very important, develop and diversify the local investors. So it's not just about foreign investor, it's about a mix of domestic and foreign investors. And again, that pipeline issue, so that comes as part of a longer term agenda, where all the elements come together, and the combination also of the SOE approach, sectoral approach, as well as capital market one. So recap of the key condition for success and impact. And again, it's not about the privatization. It's once the decision has been made, how to move forward. Precondition for success, political commitment, institutional competency, transparency. Second, robust capital market infrastructure with good access to foreign investors and the right choice of SOEs. And then the drivers of impact. So success and impact being quite different in that discussion. We think the broader picture of the capital market development and SOE, and then the impact and the long-term element. So looking just at capital market, really the domestic institutional investor base is one of the important conditions, economies of scale and macro stability, as that needs to be part of a broader economy-wide approach to capital market development and role of SOEs. So now we've tried to look at what does that mean in the context of Africa. So our sense is that there are no very straightforward answers. So there are lots of pros that of SOE listing can offer opportunities for many African governments. It should really be considered as a serious opportunity, as a potential investment solution, in particular for large SOEs, but only, and that's the contra, if the right conditions are in place, really to maximize impact and to make sure that it's not just about specific transaction and one-off, but part of a broader plan with the objective of developing a capital market. So as mentioned at the start, there are lots of SOEs currently not listed, so that provides a lot of opportunity, and several of them in sectors where they can be in very competitive sector, very capital intensive, so financial services, telecom, infrastructure, energy. So there is a potential there that deserve to be strengthened. And some countries which in our view have very strong listing opportunities, so Morocco, South Africa, and Egypt, but it's not limited to those countries. One of the challenges is for the smaller African markets with limited SOE listing experience. There are probably quite a bit of work to be done before. So first is to build the technical capability and competencies and credibility to execute public offering, attract reputable investors, because trust is one of the very important elements, as well as credibility, and ensure that those investors can take long-term equity position, so that there is, again, a plan over time. Same situation for this smaller economy, which is the build the market infrastructure, and finally create economies of scale. And that's where some regional approaches that we see on the African continent are very important. So regional integration is one of the examples. So we see that in WAMU and SEAC, or access to regional hubs, as you can see for South Africa or Kenya in Eastern Africa. So this is something where a strategic approach on scale is very important. Now, what we see also in terms of strength in Africa, improvement in corporate governance framework, at least on paper, probably more to be done on enforcement, and low listing costs. So really, we see opportunities and threats that that call on African government to think carefully and really probably use the SOE listing as a way to bolster a domestic capital market. And as mentioned, still quite a bit of work to be done on domestic institutional investor base, improve the macroeconomic environment, think of that pipeline of profitable SOE and that sequencing of sectoral SOE reform before going to market, improve institution, and as I just mentioned, economies of scale. So obviously there's a timing angle. In the post-COVID, there's still a lot of question mark on balance sheet performance of SOEs. So that's something to be managed carefully, and be careful with the potential set-off due to the pandemic. So again, the timing being something to manage pretty carefully. So we think that there is really a potential as long as due attention is paid to this precondition, and that this is part of a strategic approach and over time approach with a progressive build-up. And we hope that these lessons learned from experience in other parts of the work can be of interest to our African colleagues as they think it through. So the report is available online. Please do not hesitate to download. The IFC and World Bank teams are very much available for follow-up discussion. And I mentioned the name of the author, Annika and Michael. Michael is actually on the next panel, so you will be able to hear directly from him. And with this, and without further ado, I'm going to hand over to our colleagues on the panel, and in particular, my colleague Richard from the IFC, who's going to manage that panel with all of their colleagues. Thank you very much, and really a pleasure to have been able to join you today. Bye.
Thank you, Jean. Colleagues, my name is Richard Eckrich. I'm with IFC, and I head our collaborations and co-development group, which does early stage investing in infrastructure throughout Africa. It's my honor today to chair a panel, which I'm going to begin by introducing the organizations. I'll ask each of the participants to introduce themselves personally, and then I'll make some opening remarks and start the panel. So today we have representatives from a representative from Oliver Wyman, Africa 50, Atijari Bank, and the Nigeria Stock Exchange. Could each of the participants please introduce themselves?
Yes, thank you. So my name is Michael Wagner. I focus on capital markets development and market infrastructures in the Americas, which includes both North America and South America.
Thank you. The next panelist, please. From Africa 50, please.
Thank you, Richard. My name is Opio Forekume. I'm senior partner of the Africa 50 Infrastructure Acceleration Fund. It's a new fund that we recently set up, focusing on investing equity, quasi-equity across various infrastructure sectors throughout the continent of Africa.
Thank you. And the next panelist, please.
Thank you, Richard. I'm Taha Jaidi, the General Manager of Atijari Global Research. AGR is the analysis and research subsidiary of At-Tijari Wafa Group. Its main mission is to cover the African financial market where our group operates, mainly in the North, Central, and West Africa. And thank you for the invitation.
Sure. And do we have any other panelists that need to introduce themselves, please?
Thank you, Richard. My name is Olamide Bolumali. I oversee listings, head the listings efforts at the Nigerian Exchange, probably Africa's most recently demutualized exchange, a subsidiary of the Nigerian Exchange Group. My responsibilities beyond listings of corporates is also uniquely listings of state-owned enterprises. And a pleasure to be here.
Thank you, panelists. Let me begin by just making some opening remarks just to set the stage. The COVID outbreak, it's been a searing experience for all of us. And it's one that has affected health, finance, politics, society, and add aspects of climate change as well. And, much of life, I found it's been in anticipating crisis. And sometimes you have a vague idea of what that might be like. Not so this past year. And now more than ever, it's important to add efficiencies to the vital work that all of us do in infrastructure. And if you look at the road to recovery, capital markets and exchanges in particular can play a vital role in accelerating recovery, finance infrastructure, and governments and SOEs. So with that, I'd like to begin by asking the gentleman from Africa 50 to discuss how stock exchanges, in your view, can help bridge the financing gap for infrastructure, and how can we de-risk infrastructure investments?
Thanks a lot, Richard. Again, your contexting is so important when you look at what COVID has done, especially on the financing side. You're seeing on the balance sheets of governments much larger debt than previously, and probably more than they can sustain. With supply chain and other disruptions, you're seeing weaker balance sheets at the levels of private enterprises. And there's just generally strain everywhere. So we need to find more and more ways, innovative ways as well, to, in the case of infrastructure, help bridge the financing gap. And capital markets happen to be the largest source of infra financing in many developed countries around the world. Our particular challenge in Africa, and Jean-Pierre's presentation earlier, I think, was very insightful and informative, is that in Africa, they're mostly underdeveloped, they're not deep enough. And so much more needs to be done to get us where we need to. But if we're able to get the scale, the depth, the variety, the liquidity that is required, you can find that stock exchanges, for example, in the case of SOEs, could be a way that governments raise capital through listing them via IPOs. There are several examples where this has been done successfully around the world, including in some African cases. So that's a very, very important aspect. The other thing as well about stock exchanges is that obviously when well structured, they can help to improve the regulatory and the economic environment. Now that brings confidence into the market. It also means therefore that investors are more willing to play in it. And for investors, for example, like us that participate in infrastructure, these markets can also provide really good exit opportunities, when the time comes. So liquidity is very, very important. The stock markets, the capital markets also provide the opportunities to bring in other forms of investors. In the infra space, whether it's equity you want to list or debt, for example, this could be an avenue through which pension funds and insurance funds and mutual funds and other such like, which have long-term investment horizons similar to infrastructure, may be able to play in that space.
Thank you.
So we see the capital markets extremely important. Thank you.
Pardon me. I didn't mean to interrupt, sir.
No, go ahead. It's okay.
No, I was actually going to, if you don't mind, I was going to ask Michael if he could expand upon your remarks and also share his experience, or rather the Brazil experience on financing infrastructure. So if it's okay, I'd like to turn it over to Michael.
No, thank you. So I think market infrastructure can certainly play a role. So I think projects that in certain industries, as we also found in our report, can certainly be financed through capital markets. So in the energy sector, for example, right? I think other sectors are much harder, right? So their PPP structures or even development bank support is often needed to get the projects off the ground, and to also make sure that consortia and information that gets passed on to consortia is all managed in an orderly process. So I think as we think through different stages of projects, there's certainly a role of government and development banks in the early stages, right? When projects get formed, when financing for the construction and so forth gets raised. At the later stages, we think capital markets become more important, where basically as projects transition into operation, or certainly during operation, you can certainly look at financing structures that access a broader set of participants. And I think the important thing is, as was just said before, a lot of these investments really are suited to longer-term investors. So having a structure of insurance companies, of pension funds, and so forth is hugely important in order to have the demand for these type of longer-term infrastructures. We've also seen some markets engage retail investments, which in some instances in Brazil, for example, has been successful, but it also comes with extra complexities around structuring, and you need either development banks or local banks to be able to structure these bonds and distribute them to retail investors. So we think that as we look at different types of projects, different types of financing are more appropriate, and specifically on the more liquid side, both for infrastructure bonds and for equity investments, or even larger projects in the energy sectors can certainly be financed through the capital markets.
Thank you. And sir, since you mentioned local financing, and because I know that this is a vital issue in Nigeria with respect to financing infrastructure, I'd like to pose the question to my colleague from the Nigeria Stock Exchange about the benefits of financing through exchanges versus other financing sources, and how can stock exchanges help SOEs finance their programs and diversify their financing sources, keeping it in the context or the volatility that your country has experienced in the Naira over the past year, and actually past several years, especially lately. Thank you, sir.
It's a very good question. I mean, if I can kick off, let me start by saying that exchanges perhaps almost uniquely have the opportunity of aggregating capital from both retail investors, domestic institutional investors, international investors, and even in certain instances, private equity investors. So that presents as a significant opportunity in order to aggregate various pools of capital to support these investing in state-owned enterprises. But you raise a very valid point within the Nigerian context, especially around the volatility around currency. What is becoming more important and more clear to us, certainly in the last few years, probably over the last 5 to 10 years, is that there is a need for more domestication of investment. And quite fortunately, what we see in Nigeria is that there is quite a sizable pension fund investor base. But there is a capacity and an education piece to it, that whilst these opportunities may present themselves, pension funds, I guess, need to be trained and taught in seeing these asset classes and seeing these opportunities as investable, and benchmarking their investment horizons alongside their contributor demands. So one of the things that we see in Nigeria is there's a real opportunity to try to drive and locally aggregate capital to these opportunities. Stock exchanges also support with, if you can call it a bilateral investment scenarios where there is more susceptibility to political influence. Indeed, we are talking about some version of privatization here. So by democratizing ownership of these entities, it tends to be much better from a governance perspective, from a transparency perspective, from a disclosure perspective. And one critical issue that we see certainly in Nigeria, which I think Jean had talked about, is the area around pipeline development. There are a number of state-owned enterprises, but many of them aren't in a position for listing. Many of them aren't listing ready. So at the exchange, what we've had to do is almost go further in and further back, or around, education and explanation, and even creating an ecosystem that can support the state-owned enterprises in a bid to work them towards listing. But the Nigerian situation, I don't think, is unique within the African context, but quite clearly a need for more domestic capital formation with respect to state-owned enterprises, especially within the context of the COVID world, where government balance sheets are significantly strained. It's certainly something that we are working very intensely on, and we see as a significant opportunity. There's also the catalytic effect that a public listing of a state-owned enterprise would do and would give to the broader capital markets, because indeed, if an enterprise is state-owned, becomes publicly quoted, then it often encourages and incentivizes private operators that operate in the same sector to come to the capital markets.
And if I could actually mention, sir, I mean, one innovative project that your exchange listed was a Nigeria Infrastructure Debt Fund by Chapel Hill Denham, which listed a few years ago, which is an evergreen fund listed in Naira to finance infrastructure. And I thought what was remarkable about that one is that your exchange and the sponsors took a number of steps to make this this listing pension fund friendly, meaning it had the kind of rating that was and governance and other key aspects that the Nigeria pension funds needed. And I recall that started as a really kind of a small idea, and I think Chapel Hill Denham has been extremely successful in raising capital around this. And I am hopeful that this and other innovative listings that your exchange has been working on with the Nigeria finance community continue to be successful. Because I just think having worked with your exchange and with some of the sponsors, especially the last few years, I've been extremely heartened by some of the projects that your group has sponsored. Sir, if I could just shift gears to Taj, could you perhaps provide some context in terms of what we can learn from the Moroccan stock market experience and the impacts of SOEs and the stock market, particularly as it relates to infrastructure, but maybe other vital areas of the economy, maybe areas that we don't necessarily consider key parts of infrastructure, such as maybe non-traditional parts such as telecom, health, logistics, and maybe what have you seen in terms of what are the key success factors for listing SOEs?
Okay, thank you, Richard. I have a short presentation that I would like to share with you.
Please.
Thank you very much. So I think the topic of listing SOE and financing governments is showing great interest, mainly during the health crisis. As you know, most governments around the world have announced major economic stimulus plans, which represent significant parts of their GDP. The main issues that arise today for governments are how to finance these economic plans, and also how to diversify their financing sources. We all know that for developing countries, the external financing on international market is relatively limited. And also the domestic financing could generate the rise of borrowing costs for local companies. That's why we believe that the stock markets can play today a greater role in financing African governments. So according to our own experience, analyzing this topic requires a well-assessed of the relationship between African stock markets and the financial community as a whole. So we found that the African stock markets, mainly I can say the North, the Central, and the West, suffered from a less favorable perception from economic players. And here we can see this image, because if you look at this image, it illustrates the perception issue for the African market in general. Concerning Morocco, so many economic players still consider the stock markets too limited, with exceptional trade flows and sometimes valuation level disconnected from the economic reality. And we believe that this perception is one of the reasons that reduces the regular access to stock markets. However, if you look back to the image again, you see that the hidden part of the iceberg, which is greater than the visible one, and that point will take me to a very important idea, which is the Moroccan stock market has proved in the past great capacities through the mobilization of domestic saving, to a better valuation of state assets, and 3, high visibility of state sectoral plan. And here we have 3 examples that illustrate the capacities of the Moroccan stock markets. The first one concerns the telecom operator, Maroc Telecom, which is historically owned by the Moroccan states. So in order to finance their budget, the Moroccan government put in the market a portion of their stakes in Maroc Telecom in 2004 and in 2019. And in each time, the Moroccan government received demands between 16 to 22 times of what they ask for. And this example clearly demonstrates how the state can finance more easily and in a very short period its budget needs through the stock market. And also, if we take, for example, Marsa Maroc, the Moroccan port operator, since the IPO in 2016, the stock price has increased by more than 250%. And this constituted an opportunity for the Moroccan state to sell 35% of the company capital in July 2021, which generated 5.5 billion dirhams. So this value creation is justified by the impact of the ambitious Moroccan port strategy plan, which has been well appreciated and well valued by the Moroccan financial market. So this example shows how the states can take benefits from the stock market in order to get a better value of its assets. The third example, Cozumar, which is the sugar manufacturer in Morocco, illustrates also very well the market communication. So Cozumar benefited from the most famous Plan Maroc Vert, launched by the states in 2008. And in consequence, the group improved its sugar yield by 44% and multiplied its exportation by 6 times. So thanks to the Plan Maroc Vert, the stock Cozumar shows one of the best performance in the Moroccan stock market over the last 5 years. So when local and international analysts talk about the stock Cozumar, they always highlight the success of this strategic plan of the Moroccan states. Now, to conclude my presentation, I will share with you two major recommendations for a win-win relationship between SOE and the financial markets. So we believe that the Moroccan government should develop a stronger relationship with the financial market in order to take benefits from its great capacities. The objective for us is to integrate the stock market in the economic development model of the Moroccan states. For example, the Moroccan state can provide a provisional timetable in terms of listing of SOE for the next 2 to 3 years. The second recommendation is that the states should favor the listing of the most impacting thematics in terms of value creation and international visibility. We selected 3 thematics that form part of the strategic development plans of the Moroccan states. One, the green energy. Morocco has already started a promising chapter in terms of energy transition, and this significant investment effort will allow Morocco to become a major player in this field. 2, the pharma sector. Recently, Morocco has launched an ambitious health strategy over the period 2021 and 2025. On one hand, the objective is to become an African leader in vaccines. On the other, Morocco aims to become a global player in the coming years in the therapeutic cannabis use. 3, the mining sector. All we know that Morocco has launched a promising program of hydrocarbon exploration through 13 international companies operating in the country and 54 mining exploration licenses. And we believe that in the coming years, the coming years will be full in announcements of new deposits of oil and gas. So today we believe that the context is favorable to start a positive momentum in terms of listing SOE. Our conviction is supported by the results of our AGR confidence index. So the aim of this index is to assess the sentiment of the most influential financial investors regarding the main subjects that impact the Moroccan stock market. And if you look at this chart, you will see the significant move in terms of perception of financial community towards the impact of the political context on the stock market. So the investment sentiment is reaching an all-time high in terms of confidence and optimism. Recall that in the Q4 21, 88% of the most influential investors in Morocco anticipate a favorable impact of the political context on the stock market. So with this, our conclusion is very clear. So the government should capitalize on this favorable momentum by strengthening the link with the stock market in order to reach a high value added relationship. So thank you very much for your time.
Thank you, sir. If I could come back to the gentleman from Africa 50 and maybe shift topics a bit, and maybe we can discuss this amongst various panelists. Perhaps you, sir, could you give us your perspective on governance and transparency and how important that is? I mean, we all know it is important, but maybe you could get into some specifics with respect to how that affects the financing of an SOE, either through a private or public, private investment or a public listing. Could you perhaps give us your perspective and your organization's perspective, sir?
Thank you. Look, transparency and good governance are absolutely critical to the comfort and confidence that influence whether or not an investment will be made, especially by private investors. And it's as simple as this. You're seeking a guarantee that what you put in will come out the way you expect it to be. And ultimately, this is about being able to make a fair risk-adjusted return. Now, when you're focusing on SOEs, some of the challenges there is historically, there may have been, for example, inefficient reporting or systems in place. Some have not produced audited accounts for several years in various companies or various countries, I beg your pardon. And in some cases, there may have been leakages, very difficult in balancing the books. All of these, frankly speaking, can frighten off investors if they don't believe that there is a way that they will be able to bring around the relevant change, certainly when they invest, but even better still, when they're doing due diligence. And if you're looking at an SOE, it's well advised to do very rigorous DD. But this itself can be hampered when there's a lack of transparency. So again, governments will be advised when they're putting SOEs up for market or going to listing that they really clean out the house. They prepare, if you like, the terrain very well. Otherwise, it may very well distract. Now, in some cases, it may be possible to get multilateral institutions, maybe AFDB, MIGA, even IFC that you represent, Richard, to maybe provide guarantees or first loss provisions to help catalyze investors coming in. Now, the fact that institutions like those are present in a transaction would certainly give the kind of confidence that is needed. And I dare say Africa 50 also, we find that in wherever we're participating, that also helps. So, I can't emphasize enough just how important governance is, transparency in reporting, transparency in systems and in the way things are done, and moving the SOE in a direction where eventually it complies fully with all the appropriate corporate governance standards, ESG governance, etc., is fundamental. I'll stop there.
And sir, if you don't mind, if I could just add to your remarks, because the audience we have listening to this, if I could add that AFDB, World Bank, IFC, all Africa 50, all of our respective organizations have got specialists that are expert at dealing with governance issues. We all have governance and transparency groups that are ready, willing, and able to provide that early stage, I guess you could call it consulting experience, to assist in preparing companies, SOEs, work with sovereign wealth funds, sovereign entities, to address some of these issues. We've all worked on those, every one of these panelists. And what I would say is having a high degree of transparency and governance is in of itself an extremely important competitive advantage when attracting financing. And unfortunately, what I've found is that it's not a question of what rate you pay. It's a question of whether you get access to the financing at all. Thank you for allowing me to add to those remarks. I think that in terms of additional, maybe the gentleman from the Nigeria Stock Exchange, if you could also speak to the importance of transparency and some of your experience and how you deal with it in the context of the Nigeria Stock Exchange, some of the provisions that your group puts into place to ensure a high degree of transparency. Thank you, sir.
Yes, thank you. If I can just sort of piggyback from something you said earlier around, it doesn't necessarily reflect in the rate you pay. It almost becomes a binary conversation. It's either you have a base level of governance that allows me to participate with you, or you don't, in which case I'm not interested at any price. And we've certainly seen that. And what we're seeing, and I should stress that within the Nigerian context, there is the federal government level of state-owned enterprises and a state level of state-owned enterprises. And what we see is that there almost is a divergence where certain states, by virtue of the way and their antecedents and the way they've sort of run state-owned enterprises just historically, are a lot more quote unquote attractive to potential investors. We certainly see that because what we do in our engagements with state-owned entities is we try to just understand their listing readiness. We come across situations where these organizations haven't been corporatized, in that they're not run as separate entities. They're really run as an agency or a department of government. And of course, we partner with organizations that are more in the consulting phase to try to help these organizations, these entities, to become more market ready. But the corporate governance comment is an important one. And what we felt was, let's put in place the necessary structures, or give guidance on the necessary structures such that those corporate governance requirements can be put in place in view of a potential investment opportunity or an exit by government. Certainly in our engagements, we haven't seen enough understanding of the importance of that, but it's certainly something we spend a lot of time to try to, working with partners to try to get that message across. Because you're absolutely right, the corporate governance conversation really is a binary conversation. It's not a pricing conversation.
Yes. Gentlemen, if I could, to the panelists, if I could shift gears and talk in more general ways about SOEs. If I could put to both to Michael and to Haj, starting with Michael, if you could talk about what measures are required in your view to ensure that SOEs have a long-term benefit to their host countries, and and avoid some of the potential drawbacks. If you could speak to that, because I think that, as we go forward, there are new SOEs, new sovereign wealth funds being created, or certainly being thought of by governments, by various governments and entities. So if you could talk about, in your experience, what are the, in addition to transparency, and actually you can talk about transparency and governance, because that's important too, with respect to new SOEs and sovereign wealth funds. If you could talk to us about, in your view, what the necessary measures are to ensure that these have a long-term beneficial effect to their host countries.
Mm-hmm. I think the first criterion that we looked at is that the government has should have a program, right, in choosing SOEs, selecting SOEs that is accessible to the public and to public comments, right? I think kind of having a general consensus around these privatizations, which they often are, is often essential. And for that, the process of choosing the listing, but also in some degrees delisting SOEs is in our view very important. And here the government is really in the needs to organize transparent processes that draw in the required specialists, but also is open for public consultation. The other, once you've made a decision on listing, I think the pricing, as we discussed earlier, is equally important. So pricing it too high or too low is an issue. Retail participation matters, as we've seen in the Safaricom example. So here, kind of getting the pricing right to get the SOE off a good start, I think is also important. And the other important aspect is that the SOE is profitable, or at least on the way to profitability. So any restructuring that needs to be done is hard to do post-listing, right? So the restructuring process or processes that we looked at in our report had to be well underway in order to guarantee a successful listing, right? And then once an SOE is listed, the governance, as we just discussed, becomes very important. But governance is, but here the stock exchange is often helpful in drawing best-in-class governance requirements for listing and then basically following those through in terms of their requirements and disclosure requirements as well. So I would say those probably were the most important things that we found throughout our study.
So, sir, if I could come back to one of your statements, you talked about restructuring process. That sounds to me, of all the things you listed, the most challenging. Could you talk a little bit about? Could you expand a bit upon that and some of the challenges that you found and your organization has found in restructurings? What have been the biggest challenges? And I mean, in terms of everything from time to money invested, and what do you actually, maybe start by explaining what do you mean by restructuring?
Yeah, it's basically restructuring means kind of organizational alignment, so on the governance side, as we discussed, but it also often, in the case of SOEs, means financial restructuring and restructuring of the workforce, right? So often you have and you know, with workforce also we're talking about cost base, right? So these measures often are inevitable, and you know, in the choosing of the SOEs, we also found that where restructuring has a negative effect on the broader economy, those SOEs are often not really good targets, and you know, the whole political process derails this very often. So therefore, choosing SOEs that can be restructured and also that are more capital intensive than human labor intensive, we found is more successful. So, for example, the energy sector has a lot more capital productivity matters a lot more than human productivity, right? So, therefore, these restructurings can be done faster. So, what we found in some cases, 3 to 5 years, whereas any restructuring that requires human resource restructuring, cost reduction, can take up to 8 to 10 years, right? So I think from a time perspective, these are better targets to be chosen because, as I said, governance and capital productivity are more important factors for the success of the companies. Obviously, financial sector is another one that falls in here. And also what we found is sectors that are experiencing disruption. So we looked in depth at the telco sector because it is an interesting example of disruption in the past through the mobile sector, right? So here we found that bringing in an experienced party that can help and contribute to the restructuring, but also has a economic, is basically bound to the economics of the restructuring is important. So we found partnerships with telcos or others that can afford a know-how transfer and and also management experience transfer is essential. But and here we found, because of the need to restructure and the need to accelerate some of these projects, those can be achieved within 3 years, right? But those have been the fastest. We found really where you utilize an external catalyst that does a know-how transfer in a sector that is being disrupted, because the urgency is important in those.
Interesting, your time frame, sir, and I think that's important for everyone to understand is that this is nothing that happens quickly. It can take a matter of years to do a proper restructuring, is what you're saying, and you're saying that 3 years is ambitious, and that sometimes it takes longer.
Yeah, 3 years is the shortest we've seen. It's very ambitious, right? It's probably the best companies in the most suited sectors where you can do it. In most cases, it takes 5 years or longer.
Interesting, very interesting. Taj, could you please, same question. I mean, could you talk a bit about the impacts of SOEs in the market for Morocco, and talk about some of the real life challenges that you found and that your market has found in some of the challenges that Michael just discussed, such as restructurings?
Yes. So concerning the Moroccan experience, I can tell you that the listing of SOE has significant impacts on the stock markets. For example, the listing of Maroc Telecom, the telecom operator in Morocco, and Marsa Maroc, which is the port operator in Morocco, had several impacts. First, they improved significantly the liquidity of the stock markets because the SOE are in general a large cap. Second, they attract individual investors to the stock markets because the structure of their IPO favor more individual investors. And you know that this profile of investors impact significantly the dynamic of the market over the short term. Third, this operation gives more international visibility of the stock market. And thanks to this listing, the Moroccan stock market integrated many international indices. On the other hand, we note that the stock market has provided international visibility for the SOE. In fact, these companies integrated the foreign investors' radar screens over the last years. Also, the stock market improved both the governance model and the quality of communications. We have noted that the listed SOE have created special department dedicated to investor relationship. So I can say that this upgrade in terms of governance, communications, and international visibilities has accelerated the external growth of the SOE. Now, concerning the challenges, I think one of the big challenge is the management team of the SOE. According to our experience, a management team with a sustainable communication and a good understanding of investors' expectations can have a visible impact on the success of listing SOE. So this is a very important point that can make the difference between many listing of SOE.
Richard, you're muted.
I think that's happened to all of us on multiple occasions, and me probably more than others throughout this crisis, working on Zoom and MS Teams. So my apologies. If I could come back to Africa 50 and the Nigeria Stock Exchange, and talk a little bit. If I didn't want to make this panel all about COVID, but I actually would be very curious to get your views on how the crisis has affected your business and how it might have affected your approach to capital markets over the last year. There's nobody who's in attendance at this conference, and all of us and all of us panels, we've all been affected personally and by this crisis. But I'd be very interested to hear how, from your organizational point of view, this has affected your organization's strategy, and in particular how it's affected your approach to capital markets. And if it's okay, I'd like to start with the gentleman from Africa 50, if you're okay to speak on this topic, please.
Sure, Richard. Thanks for the opportunity to talk about it. I think when you look at some of the big stats that came out of the COVID period, we all know that Africa saw significant capital flight. So as a consequence, financing overall, has been tight, for everybody. And that's clearly had an impact, if you like, in terms of the pace at which projects were able to close. Another thing, and if I speak from the point of view of, say, Africa 50, but I'm sure this applies to, anybody who is operating on the continent, maybe as a fund. There were challenges in terms of, some investors struggling to meet their calls on time. So you obviously need to have understanding for how you manage such circumstances. But that being said, it has been possible to tap into financing opportunities. There's a project, for example, that we are we have in Senegal, which is converting or is built to convert eventually a power plant from a diesel-fired plant to gas, which will be a greener and if you like, less greenhouse gas emitting fuel. And we were able to, raise bridge financing for that from local banks, and we're also preparing a green bond that will help to finance this project on a long-term basis, because ultimately, again, it helps clean up, if you like, the environment. So the possibilities have certainly been there. The challenges also exist. Fundraising, for example, for new funds has also been challenging. Some of the folks who would normally come in have been a bit slow, but we've also seen an increased appetite amongst financial institutions. One statistic that I don't mind sharing is the African Development Bank estimated that at the end of 2020, there was something like $1.8 billion of assets under management by various African institutions, be they pension funds, insurance funds, SWX, etc. And so one has been able to talk to these individuals, and some of them are already putting their best foot forward and willing to participate. So if you like, the whole need for resilience of the continent is one that's now gaining a lot of root, and African institutions are playing a very important role in that. Now, ultimately, we believe that when we now have more skin in the game, this should make it even more attractive when foreign institutions are willing to come back, if you like, en masse and at scale, for them to do so, because ultimately you want to see all the players participating in the market. So that's what I'd like to share for now.
Thank you, sir. And Olamide, could you discuss the same in terms of what your organization is how this has affected your organization and what it's been doing in the context of the COVID crisis, how it's affected your strategy, and maybe looking forward now, how you think that strategy might change as we hopefully now make plans to try to recover from this?
Sure. Of course, our business is highly correlated to the macro situation in Nigeria and therefore currency. So one of the things that we've certainly seen is that from an issuer perspective, perhaps there's been a need to look more domestically at capital, given that the macro situation in Nigeria has been not very encouraging with international investors. We used to have something around 70% in terms of turnover being international. Now it's probably flipped to around 30%. So on that front, from an issuer perspective, we're looking more domestically at domestic pools of liquidity. But also from an investor side of things, there's almost like a reverse sort of perspective in that, given that the currency has moved and there's been somewhat reduced liquidity in currency, what we're seeing more from the investor side of things is an appetite for quasi dollar linked products. So for us, that's influenced the kind of product development that we're doing. From an operational perspective, of course, digitization and digital is quite important. The exchange has been working remotely for about 2 years now. And that, of course, informs the broader strategy in how we even build our business, how we engage with our customers, how we engage with our prospective issuer and our clients. But by and large, one of the things we've tried to do is to essentially expand the net a little bit and try to deepen the domestic capital markets. One key area that we're trying to leverage on is also having a digital, almost an end-to-end digital route to market, especially for our retail investors who have grown significantly, actually, ever since COVID kicked off. So we're developing solutions either directly or through partnerships to try to enhance and ease that process of accessing the capital market through digital channels.
It's interesting, sir, that you bring up digital channels with respect to Nigeria. Have you found that over the last year and plans in the future that your organization's focus on technology, new technology, or using existing technology, I should say, and then other organizations' plans as well, is that starting to make greater demands in Nigeria in terms of further developing even further its digital infrastructure to support both capital markets, but also private markets and private and SOEs, SOE type businesses?
Certainly in the broader market, in the SOE space, we quite frankly haven't seen a lot of that. I would argue that the SOE space, certainly within Nigeria, is still relatively behind the curve in terms of development, but invariably there will be catch up at some point. But certainly there's also additional strain for more digital and digitalized solutions on capital market offerings. And it's really across the curve. We're having conversations with people looking at alternative technologies and leveraging new technology streams and trying to adapt those to what are traditional models within the capital markets, whether that's private markets, whether that's some sort of looking at a blockchain use case for depository. There are a whole bunch of other things that we're looking at. Are initiatives that have been thought about for a while, but perhaps have been accelerated by COVID and the digitalization that it's inspired.
Thank you. Ladies and gentlemen and conference attendees and speakers, I'm going to close this panel out. I'd like to close by simply saying that each of us attending or speaking at this conference, we're all focused on our own individual business and in our organization's business. But if you're attending this conference or you're speaking in this conference, you are either working in a development institution or infrastructure, SOE, or capital markets. You're in some area that is touching people's lives directly or indirectly every day. And the work that all of us are doing, whether by intention or not, we are all playing a part in the recovery from COVID. And because of that, I just wanted to say that it's been a great honor for me to chair this panel. And I thank you for, special thanks to the speakers and to the audience for having the patience to listen to us as we have this discussion. So thank you.
Thank you.
Thank you, Richard, and thank you to all our experts for your interesting insights on the financing of SOEs and governments. So in a few minutes, we'll move to the third panel of the day, which will tackle the key trends and implementation challenges of disruptive technology in the capital markets industry. So the panel will start with the presentation on the ASEA Technology and Statistics Working Group reports on disruptive technology by the Deputy CEO of the Casablanca Stock Exchange, Mr. Mohamed Saad.
SCL Advisory. I'd like to start actually by thanking the organizer, the African Securities Exchange Association, as well as the Casablanca Stock Exchange team for inviting us to take part in this very exciting conversation today. So today I have the pleasure of moderating panel 3 and talking about the anticipation of the future of disruptive technologies. So we'll be discussing trends, how disruptive technology have been employed by capital market infrastructures, as well as discussing implementation challenges that they are facing. Before we start the discussion of the panel, we'd like to start by setting the tone with Mr. Mohamed Saad. So I'll do a brief intro of who Mr. Mohamed Saad is. He's the Deputy CEO of Casablanca Stock Exchange. He's really a digital evangelist. He's also the president of the Association of Information System Users in Morocco, and he's going to go ahead today and do a presentation of the findings around one of the area that is very key, which is Asia Technology and Statistics Working Group Disruptive Technology. So we'll have a discussions with the other panelists, which I'll introduce right after. Thank you very much.
Thank you, Salwa, and thank you for the presentation and for the organizers for this brilliant conference. I would start by giving you a brief review about the study and survey we have conducted among the stock exchanges, Asia stock exchanges. And I would like to thank, sorry, it doesn't move. Presentation doesn't move. I don't know why.
So while you get the presentation going, Mohammed, I'll just go ahead and introduce the rest of the panelists that have joined us today, very distinguished panelists. So I'll start with you, Faisal. If you can quickly raise your hands, everybody knows. I'm not sure everybody can read the small names on the screen. But Faisal Abel Yazid is the managing director, covers Africa. Has got extensive experience to them, focusing on, surveillance, trading, settlement, clearing, and depositories area. We have also joining us Afak Khan, who is the general manager for Middle East and North Africa, as well as covering intensive experience working with capital market infrastructures across emerging and frontier markets, strong focus on North Africa, but also looking at expansion across the continent, and we'll discuss that later. And he's got extensive sectors. List John Walker Robertson. John is the global head of central banks, financials, communities, and corporate treasury solution at the London Stock Exchange Group. His experience actually spans from different areas within the financial sectors, working at investment banks, brokerage firms, as well as with financial market infrastructure. So really great having you today, and looking forward to the discussion. So Mohammed, not sure if you have the presentation going, or if you are ready, please just we'll let you kick off.
Hello, Salwa.
Yes, can you guys hear me?
Do you have the, you see my second slide?
Yes, I can see the slides that says official launch Asia Technology and Statistics Working Group report.
Fine. So finally. So, well, I would like to thank first the Asia stock exchanges, but also all those partners. I'm talking on behalf of my peers, and they have participated to that survey we have released by end of 2019, early 2020, and we have also a report, and we'll be delighted to share the all the insight with the community. So documents will be downloaded by the by all participants. So first, profile of respondents, you have half of them are coming from ICT, but you have also people coming from so you have CEOs, but also COOs, so people coming from business development, but also back office, operations and all management processes in stock exchanges. So first insights is to ask question, why all this? What are the key drivers pushing stock exchanges to adopt disruptive technologies? So mainly first thing to tackle here is efficiency, and stock exchanges are very, very sensitive to uptime, to latency, but also to business continuity and resilience. So that's why efficiency normally comes first, and you have also customer experience and fear of being disrupted. So customer experience, is a major pillar of all the business strategies. Recently, in the last 5-7 years, the say is given to the customer, and his experience is very important. So stock exchanges are also very sensitive to the customer experience. We know that customer could be an investor, listed companies, but also authorities and all the partners around the stock exchange, but also acting in the capital markets. Fear of being disrupted is something also raised, since we know, for example, all the buzz now created around the blockchain and who's gonna be eaten first, maybe. So this is something raised. That's because some partners, main actors are a little bit scared of what blockchain could raise in the near future. So here we're comparing the capital markets with other sectors, and as you can see, more than 52% are at par of or above the financial sector in terms of disruption technologies adoption. So all of them, and or big parts of them, are a little bit ahead in compared to other sectors, could be banking sectors or industrial sectors or other sectors. So what is the main approach in the next 5 years to adopt? So 60% are ambitious and developing and going ahead to adopt the disruptive technology. And as we can say in other slides, this have a really a return in investment, since developing and going ahead could make us gain some parts of growth or revenue or other opportunities. So what are the main disruptive technology used nowadays? So mobile and data are leading disruptive technology, and this is I would say natural, since it's a little bit linked to that customer first and customer experience. So that's why mobile technology and all data, could be smart data or big data, are coming ahead. So this is very important. Machine learning and artificial intelligence are also at 25%, means that they are used mainly in the surveillance processes, and that could be to track bad behaviors, for example. That's why machine learning and artificial intelligence are adopted by software vendors, machine engine also software. So that's why artificial intelligence is also adopted by major markets. So in the next 5 years, you can see that, for example, intelligence analytics could be adopted in the next 3 years. Big data is within 1 year, since we know that all those stock exchanges, but capital markets, they hold huge amounts of data. So We have opportunities behind big data analytic, but also mobile applications, since that's something that could push the investors to use applications, brokers applications. Blockchain is a little bit lagging behind. That's because we're waiting for high, big added value experiences so as to adopt that kind of technologies. So when talking about innovation, big parts of those stock exchanges are in the stage of development, could be implementing or investing. So most of them, they are using agile methodology to go ahead and to adopt disruptive technologies. So here we're talking about how to invest and how to go ahead and what kind of models. So 64% of respondents prefer to join forces with other stakeholders, could be fintechs or startups or partners or university or innovation labs. The example I would like to highlight here is our partnership with a sister company, the CSD, Moroccan CSD, Moroccan. So we are investigating many technologies so as to go ahead and beyond. So together we can go faster and further. So that's why joining some partners like fintechs could help a lot in this journey. So what are the top metrics? I'm trying to go fast so as to let the major part of our panel to discussion and QA. So growth, revenue growth and return on investments are the key factors that could help the capital markets to fulfill those projects. So 72% of target direct impact on revenues, new opportunities, and cost savings, which is very, very interesting in terms of we're not doing that for fun. We're doing that's because there's a cause, there's something, there's a why, there's a sense, and there's something behind those kind of projects. So what are the risks? Maybe we have questions also those partners about the risks. So cybersecurity is the biggest one. And I would like to say with or without disruptive technology, cybersecurity is a never-ending battle. So that's why, most of the respondents are putting cybersecurity as the major pillar in terms of risk response, and today cybersecurity strategies becomes part of the development strategies. So how to mitigate risk? Maybe three answers: education, and again education. That's why we're talking 40% are talking about skills development, so educating people inside, outside, investors, everyone should be educated so as to mitigate those risks. Last but not least, maybe as you can see, the survey was conducted early 2020, end of 2019. That's why COVID impact is not raised here, and maybe a refresh in the next month, next week should be interesting and more appropriate to maybe tackle the cloud, maybe cloud computing technology and other technologies that could help the stock markets, capital markets in general to go ahead and to adopt disruptive technology. Thank you, Selwa, and I'm at your disposal to answer questions or also give my point of view. Thank you.
Excellent. Well, thank you so much. Yeah, thank you so much, Mohammed. That was really great and an excellent way to set, our discussions now. So I would like to talk, and really this is a question for all of you. We've seen the great presentation, Mohammed, highlighting some of the key disruptive technology and the responses that he got from key market participants, particularly stock exchanges in Africa. What do you see, Afak, Faisal, and John, in terms of what specific sort of disruptive technologies have been adopted right now in capital markets. If we can get more specifics around that. So Afak, if you could start, that would be great.
Lovely. Yeah. Thanks, Saad, for setting the tone, and Salva for making this lively. So as comes to capital market infrastructure system, we as Directive has analyzed that there are 9 key technologies, some that Saad has already touched upon. But we believe that there is a very clear adoption that is happening, and we are talking way broad in terms of how globally, and then to make it more interesting for the audience, how it's panning out in Middle East, in Africa, in the region that we are basically concerned. So these technologies are basically that we think are, and there is a sequence to it that we basically are thinking that this is the way it will grow. So first thing is basically about cloud. Saad has mentioned that about cloud computing. I want to say cloud technology. Second one is about externalization of processes and services. Third one is RPA, which is robotic process automation. And then fourth, big data we want to call it analytical analysis. And then it rolls down to digital transformation. It rolls down to smart contracts, artificial intelligence, moving on to blockchain in the end. But that's the way we think that these technologies are going to basically have more of a nature to impact this specific industry in which we are basically, or the CMI, capital market infrastructure. Now, is my screen clear? Is the screen clear? Can we see the screen?
Yeah, we got you.
Lovely. So these are now you can see in picture that these are, so the cloud technology, process services externalization, and then basically to RPA, and then advanced analytics, and then to basically digital transformation, and then to artificial intelligence, and then to go in terms of smart contracts, Internet of Things, that's very important as well, and then blockchain. Now with this diagram, perhaps you can see these are the technology which are going to impact everyone all across the industry. Then there is this interrelated impact that some of these technologies are doing, and that's where the fun starts, because rather individually as collectively they can have this focused capital market infrastructure to be impacted. And that's what we see as Directive and Salva in a very broad scale. That is going to be a very effective way of seeing how these individuals can pan out, how to impact the CMI levels.
I think that's really interesting. Faisal, I think do you have something to add on this before I jump in?
Sure. Thank you, John and Afak, for the insights, and thank you, Mohammed Saad, for the analysis and the research you've done with ASEA members. It's quite insightful, I think. Just on that point, we've done a study with the Select Group commissioned by NASDAQ with about similar research, asking CIOs mostly of market infrastructure operators to tell us what they think about the future of disruptive technologies, and also where they see themselves in that environment. We have shared that study with your organization, and if you don't have it, if anyone in the audience is interested, please shout out, and I'd be more than happy to share that with you. But following up on what Afak said regarding the innovative technologies that a stock exchange like NASDAQ is adopting, I'd like to go back a little bit and explain what we do for those who are not really familiar with NASDAQ, as we're known as a stock exchange group that operates across the United States and the Baltic region and the Nordic region. But we also operate a business that we call Market Technology, where we are a major technology provider for infrastructure operators and market participants and banks and regulators around the world. From our perspective as an exchange operator and a technology provider, we observe a few technological trends globally and across various different regions, actually in the region where we're present. Cloud, in our opinion, is a great enabler. It does help market operators to flexibly scale as volumes fluctuate and obviously as market participation increases. During COVID, we've witnessed some serious volumes in trading, and in order to scale for such volumes and in order to cater for those volumes, you need to be able to move quickly and efficiently and not focus on infrastructure per se. So cloud is definitely a great enabler there. Another aspect that we look into very closely related to the RegTech, and that's in AI, how we use machine learning in order to make sure we help our governance organization become much more efficient in terms of evaluating false positives for that matter, and basically getting rid of all the false positives and helping with triage and helping narrow down the interpretation of various different alerts and reports. And that's becoming much more important now when it comes to our reach into the anti-money laundering business with our most recent acquisition of Verifin. So as we are becoming increasingly digitalized and the ecosystem we operate in is increasingly digitalized, we, as the vendor of technology, we're focusing on what we call software as a service model. Not we call it, it's known as a software as a service model. And that's that helps develop and build technology solutions for both traditional marketplaces and also new types of marketplaces using plug and play cloud-based components. This is an approach that we find reduces time quite dramatically to market and also does include a lower total cost of ownership if you look at how much funds you have to allocate for infrastructure and overhead, hardware, etc. But most importantly, it lowers the threshold of setting up an efficient and reliable and also scalable marketplace for both digital assets and also traditional asset classes.
Excellent. Thank you very much, John. If you haven't answered, apologies. I'm in London, and sometimes we have issues with our connections. I heard that from Nandini this morning, and it seems I have the same problem. So, John, go ahead, and please. I'm not sure if you have answered. If not, please go ahead. Thank you.
No, that's no problem at all. So I think we're all in the cyber environment used to the difficulties of.
Here he's talking about technology. Go ahead.
It's right. And here we are talking about technology, and these are the troubles we have. So I'll keep it brief. I think I agree with the set of innovations that we talked about at the top, and some of those key ones as well, how they manifest themselves. In particular, we talk a lot about cloud, and that's going to be critical to development in many markets in terms of financial market structure and other technologies as well. But I think for us, we think about what does it all mean. So we see this. I love that chart that we saw earlier. That's fantastic. A really great way of visualizing it. But what are the outcomes that our customers are trying to achieve, right? And it is that it's lower cost of ownership. It's services that are more efficient and easier to run. And for why? Also, we can unlock capital, right? So we can get investment into these markets, into the exchange. Through that, we can see sort of harmonization of financial market communities, and we can see economies grow. That's really what we're talking about here. So I think perhaps for the audience, there's a lot of so many ideas here: AI, machine learning. We're going to talk a bit about central bank digital currencies, I'm sure, in a bit. But really, what's the chief outcome here? It's efficient markets, and it's getting capital unlocked, and that's what we need to kind of sort of focus on.
Yeah. And obviously, the customer always being at the center in terms of providing better services, more efficient services, which really is linked with what you guys have spoken and what Mohammed has said earlier on. Are we seeing those trends growing, and in what specific area of disruptive technologies? I mean, sorry, I got the end of what you said, Faisal, in terms of cloud, but really, are we seeing an increase in those trends, particularly in Africa? Afak, if you can please just go ahead with that one.
Yeah, lovely. So that's where, what we see that there are trends basically which are falling. So some are basically proof of concept. So those are actively experimented, but the benefits are lower. And some are point solutions which are addressing a very specific nature of those areas, and some are enterprise-wide. And potentially the last one is the game changer and effective. I heard what Saad has said. We tend to think that as of today, there are blockchain, Internet of Things, smart contracts, and artificial intelligence all going through a proof of concept stage. And digital transformation, advanced analytics, robotic process automation, and process services externalization are the one who has already recognized that the point solutions they are addressing. And no doubt about it, everyone has basically touched upon this, that the cloud technology has already reached the enterprise, but it's a 15 years old technology, is not something very new, but nevertheless, it's the only one which we see has already reached a mainstream reach. Nevertheless, there are challenges, but that's the way we think that the trends are spanning out now in this industry.
Yeah, and we'll talk about the challenges later on, particularly, obviously, as you mentioned, in all these areas and in particular. But Faisal, what trends do you see, picking up? Whether currently, obviously, you're covering very much the region. What trends do you see right now?
We've come across quite some interesting ventures across Africa, and they're not necessarily incumbent exchanges, but these might be new marketplaces where they want to introduce new types of digital assets entering into the space that are actually born in the cloud and can basically more rapidly deploy trading and surveillance, for instance, to get up and running quickly. But we also see in Africa that there will be a coexistence between the startup exchanges and the more incumbent exchanges, where both, the incumbent exchanges will have no choice but really adapt new technologies and become a little bit more nimble, but also not only for technological advancement and getting things done more efficiently, but also for their survival. So the exchange grade systems that we see are being adopted by various different marketplaces across Africa will evolve transparency and the security standards of the capital markets of more advanced marketplaces. DLT comes to mind also, Selwa. So obviously we see DLT as a technology enabler, right? I mean, we don't develop blockchain technology per se, but we do adopt our technologies to be able to be deployed on the immutable record of ownership, because it does create efficiencies and transparency in position keeping and reconciliations. So I think these are trends that we will see ongoing in across Africa. And also there is, again, I'm not going to talk challenges because you have another question about challenges, but we see that the cloud adoption will have to become more compelling with more incumbent marketplaces or market infrastructure operators, as I said, because it's the way to go right now, and we see that governance is becoming more flexible when it comes to creating rules and regulation around data sovereignty and how to use the cloud, whether that be for production data or for test environments of that data. So yeah, and also I think the SaaS model I mentioned earlier, we are in current discussions with potential clients for SaaS deployed solutions that would get them up to speed quickly, especially for startups that don't have time and funds to manage their own data center and have an overhead of IT operations. They want to just focus on the business and expand through adoption of service or a third-party service to help them get there.
So who would be particularly those takers of, you mentioned early stage companies, so who would be those takers particularly of SaaS technology?
It could be a traditional stock exchange that wants to, as I said, shift their focus from managing their own data center and hardware, or it could be a startup company that is actually born on a cloud, native to the cloud, and they don't know any on-premise deliveries. So it could be both.
Mm-hmm. Okay, great. So John, what do you see, like, around the themes of disruptive technologies? Obviously, we've touched around the drivers that Mohammed has done in his presentation, but where do you see really the drivers in this space yourself, from your experience, as well as the business opportunities?
Yeah, so I think we've spoken prior to today, we've been discussing this topic, and one of the key themes is kind of the regulatory drivers of these sort of changes in technology and the disruption within the market. To Faisal's point, cloud-based technology, that's a sort of standard operating model for a lot of our businesses now. But what else? Well, regulators want to see safe markets, right? Safe institutions and capital. That's why there's a trend towards on exchange and clearing. But they also want to see fairness and transparency, right? The velocity of money is increasing over time, and regulators want to see it happen in a controlled, fair, and transparent environments, right? So we need tools that help central banks and regulators do this. So that surveillance or proof of best execution, like market tracking, that kind of stuff. It's all about data. So that data, has to be presentable on a platform. It needs to be able to be utilized by our customers. It needs to be able to have overlays of analytics and these kinds of products. That's kind of critical, and that's being really driven both from a regulatory environment, but also because that's what the customer demands. There's a third thing, though, I think that probably doesn't get talked about enough from a regulatory perspective, but I think is coming, which is sort of the rise of ESG as a priority for government as well. Right, so investors, asset owners, corporations, right, we're having to navigate the transition to net zero and stakeholder capitalism, right, which includes adopting consistent reporting standards. There's significant questions around what market structures and tools are needed to support sustainable investing, and that's a challenge that needs to be met by the market. We need more data. Regulators in some countries are mandating ESG reporting from their biggest companies, and not just from their direct activities either. That could be their supply chain too. So it's just a matter of time before this impacts companies in the Middle East and Africa. First of all, indirectly perhaps as supply chains, but then more directly as the same questions are asked by their regulators. So what's the opportunity, right? Again, it's like, what does this mean for our customers? Well, safer, fair, and transparent markets are more efficient. They should have a lower cost to run. They're also more attractive to investors, and they help unleash capital. And the same with ESG. Consumer trends are directing revenue to businesses that have sustainable practices, and consequently, companies are leading the way, are doing better than their peers, and outperforming the market, right? In green indexes. So, capital markets can thrive when we've got these kind of sound regulatory frameworks. And well, what's the prize? Well, how about unlocking the capital from African pension funds, sovereign wealth, right? So that there's hundreds of billions of dollars which can be channeled into local capital markets in the right regulatory and technology frameworks.
Yeah, obviously, unleashing capital, particularly as you mentioned, John, coming from pension funds, particularly in the continent, is very difficult, simply because there's restrictive mandates around the use of that capital in specific asset classes, which is a bit unfortunate. I know some countries are pushing policy changes there, and we've seen some sort of success stories in areas in East Africa. But anyway, putting that aside, how about using different ways to raise capital, innovative way? And we are talking a lot, we're hearing a lot about tokens. Could this be a quicker, more efficient way for issuers to raise capital in a less restrictive manner and unlock and unleash that sort of a flow of money globally, not just obviously within Africa, but here it's a global opportunity. So Afak, I don't know if you've got some views points there.
Let's put it very clearly that all what we are talking about regarding this innovation technologies, it's incomplete if we don't use this word that we are sitting at an uber moment. What does it mean? That it simply means that it's all about these technologies to be put in perspective with smart business models. So you just touched upon tokenization. Now, tokenization and then securitization and then basically collateralizations, all of these things are helping out. How? Because take any example, wherever the capital is, so there is basically a demand line to it. All we need is this supply to it. How can we do that? So by having a token or tokenization, it's basically become more available, more accessible. At the same time, basically, it has this click as, let's pan it out to Africa. How beautifully the whole, they are calling Africa as the new crypto frontier. Why? Because it's very easy in a geography in which the regulatory compliance is relatively lower than what is the developed world. So all across the emerging and frontier market, the trend in terms of seeing through it is these technologies, be it any, as we mentioned, these 9 and further elaborate to that. But all of these somehow, if they put down together with a smart business model, brilliant. This is where we are sitting, that there could be a lot of moments that can come. And that's what excites us. This is exactly where DirectFN feels that there is a lot happening rather than just these technologies to be utilized, how to be utilized, what would be the business models around it that can make it, and it's as simple, matching the supply with the demand. And that's all what we are basically saying. So yeah, you picked a relevantly a simpler example for tokenization, and that's where we lead it through the infrastructure change of blockchain to be an infrastructure as just an example, but that's where it leads to. So yeah, we do see that this could be not in a very near future. I love what Saad has basically very silently said, but that has a lot of meaning. These are far off, but can we miss that train? Not at all. This is where the excitement is basically going to go.
Yeah. So I see you nudging John. Do you want to contribute there, or Faisal?
Sure. Sorry, John, go ahead after you.
No, I was just, I think this kind of leads into the conversation on central bank digital currencies, right? Yeah. It's a case of we feel like it's a matter of time, right? But it's not as simple as in or out, right? It's okay to kind of speculate. There's a lot of hype around digital currencies, digital assets, tokenization, and then that's okay from an investor side. But as a central bank, you need to decide what works best for you. Is it an indirect, direct, or hybrid model? Understanding the cost benefit is problematic because you're interested in safe and efficient markets. So it makes sense that these things are going to take time. It's difficult because there aren't a lot of use cases or models to replicate, right? We've seen a few dip their toe. I'll talk a bit about more about that in a second. But the question is, again, why bother using them at all? What is it for the customer? Well,
yeah, what's in it not just for the customer, but really, as we are talking about central bank digital currencies here, and as you mentioned earlier on, I mean, I guess some central banks are embracing them, others are more reluctant and waiting. I mean, we've seen the governor of central banks just today mentioning that he was ready to launch a committee about potentially issuing central bank digital currency, and hopefully by the end of the decade. And who knows, that seems to be quite far. But when you look at emerging markets, they seem to be a little bit more, I'm not sure if I could say advanced, but a bit more willing to embrace digital currencies issuance. I think in Africa we have a great leader, like in Nigeria. So I don't know what's your view there, John? I mean, why are we seeing those two sort of, I wouldn't say two schools of thought. There's two schools of thought and there's everything else in the middle. But what is the reluctance there for us to understand?
Yeah. Now let me jump in there. I think first of all, to AFAC's point about the regulatory environment that those markets are having to operate in, right? So it's simpler in some African markets to be able to experiment within CBDCs. And you mentioned we of course know that Nigeria developed a digital currency. I don't think we're seeing everyone go full tilt in. There's a few pilot schemes out there. There's some in Europe. There's some in China as well. And so I'm aware there's going to be more in Africa. We have customers talking to us continuously about CBDCs in terms of what we can do in order to not just help them, in understanding their kind of.
I think I believe I was thinking it's the issue again on my side, but I think it's John that has just blocked right now. It seems the London people have issues with internet connectivity, guys. Apologies for that. So while we're waiting for John to hopefully come back to life.
Maybe I can at one point, Selwa, while
yes.
John is screen is frozen. So just to add to what Afaq and John mentioned, maybe something that hasn't been mentioned yet would be the trend of retail participation that we've seen over the last decade.
That's a very good point.
That has doubled. Obviously, and there is no sign of slowing down at all. This is not necessarily a tech trend specifically, but it's an industry or market trend that will impact how we approach technology infrastructure, right? So the financial institutions and markets are becoming much more accessible to a new generation of super enthusiastic retail investors. So these technologies will enable frictionless transactions for such crowd that wants to invest. And I think digital assets are a very good asset class that defines how accessible investments can be to the retail investment, how do you say, plan or people. So we are, as I mentioned earlier, at a crossroad between more traditional marketplaces really accelerating their digital transformation efforts and actually new generation markets that are born in cloud, for instance, challenging the way we, traditional players seek investor dollar, really. So I just wanted to point that out.
Yeah, thank you. And I guess because we are dispersed, I mean, in terms, and I'll go, sorry, John, welcome back. I'm not sure if you wanted to finish your point on that, but let's just carry on. And Afaq, I wanted to ask you right now, the existing issues major issues that are, that exchanges and CCPs and CSDs are facing currently, how could this, first of all, what do you think are the key ones, and how could those key ones be addressed using those disruptive technologies, be it AI, ML, big data, DLT, etc., in order to address them and grow those markets quicker and faster? Because as Faisal mentioned earlier on, exchanges across the continent or beyond, I would say, we need to stay relevant. And obviously this is the key challenge. And so how can they stay relevant by addressing some of those issues in a quick and faster way? So, I'll let you elaborate on that if you can shed some light. Thanks.
Sure. So let's dive into exchanges, CCP, CS, meaning simply the trade and the clearing and the settlement. Now, a very good example, first of all, instead of directly going into the challenges, I first want to elaborate a concrete case. Let's take the example of Australian Stock Exchange, in which a lot of investment, 10.5 million plus investment in terms of doing what, just to replace their existing post-trade system, which is chess. And what was the rationale behind that? Simply to use blockchain, and this would be the world's first industry carrier grade installation to basically replace the conventional clearing, settlement, and asset registry to be basically on the blockchain. So now, having said that, it's exciting. Challenges, yes. This project, as someone has touched upon, that look, COVID came and this project was supposed to be delivered in 2019, become 2020, and it's moving on. But it's so exciting. Think, Salwa, and all the audience here, that I'm sitting in Saudi Arabia. Saudi Arabia moved from T+0 to T+2 to align itself with developing world. Now, having said that, when this embarkment of ASX, if this comes to be a reality in coming future, then we're going back to a T+0 market. So it's very, very interesting. It has a lot of challenges. Challenges basically are going to, nevertheless, challenges are, we can go hours and hours to talk about challenge, but what we as Direct FN feel, there's an uptick, there's a lot of opportunity here rather than just to think about the challenges. And someone has to basically jump the gun and say that, okay, let's see to it that what could be the next frontier. I'll give you another illustration where Faisal is sitting, that Abu Dhabi Stock Exchange have gone and basically they started e-voting on blockchain. Whether it was a huge success, no, there was a lot of challenges. Nevertheless, it's basically look at the point solution, e-voting. How beautifully can it be done by using blockchain technology? It's a point solution. I understand that it's not an enterprise-wide or disruptive to have. Nevertheless, these are basically the concrete examples that basically help us to see through it that it is coming and it is basically being absorbed. Another example, I think Faisal can jump on that, is Nasdaq's Link, and by Link I say L-I-N-Q, not L-I-N-K. That project was basically built on, in terms of exchange, in terms of providing the private equity, and it has taken measures, although there has been challenges. I think Faisal would be the best one to touch upon, but these are certain things which excites us more rather than diving into the challenges. Challenges are there, we can talk at length. I have a lot of points on that if the time prevails, but these are the excitements in the exchange, in the CCP, in the CSD realm, that people have basically taken initiatives, and those are very relevant. Those are insightful as well as very relevant. We can build on that.
Yeah, no, exactly. I mean, obviously, the reason why I wanted to dive in a bit in the challenges, because obviously any challenge will present opportunities, and using disruptive technologies to tap into opportunities to help those markets grow is very key. So Faisal, obviously, on your side, what challenges do you see, but also importantly looking at the risk by adopting, some of those, particularly around, we've discussed cloud being super well established, etc., or any other disruptive technologies. What are the main risks associated with that, in your opinion? Certainly, Mohammed has clearly mentioned a key one being cybersecurity. But what is your view? Do you concur with that? Through your experience on the continent.
Absolutely. I think there is risk and there is challenge. I think the challenge is so Nasdaq started becoming an electronic exchange in the 70s, 71, the first electronic exchange in the world. And obviously, it's the cost of experimentation that is a challenge to many marketplaces, because it can be quite high due to the need to acquire capacity and resources. So the Link project that Rafaq mentioned was one of them. It's a leap of faith you take into a partner that can enable your transactions on a blockchain back in 2015. So that was a cost of experimentation, which helped us learn quite a lot. So I think that's a challenge. In terms of risk, obviously, you have cybersecurity is number one on any market infrastructure operator's agenda, right? So with us, we have billions of messages every day, and we have billions or millions of threats and attacks on a daily basis across the marketplace. So that definitely is on top of our agenda. But the way you tackle that is processes that you build within the corporation and the culture of the corporation. So we have a charter at the board level that goes all the way down to every single employee, with creating responsibility, individual responsibility to each and every Nasdaq employee to make sure that they are aware of the threat. In addition, obviously, to multiple and numerous educational programs that we have for everybody within the corporation. So definitely, other challenges, obviously, as you can see. Last year with the pandemic, obviously that can also create opportunity, as you said, Salwa, where it's created a very new, big appetite to adopt new technologies, and that appetite has accelerated the engineers in our organization to try new things and new technologies at a much faster pace than if we were, pre-pandemic era. So we are for sure accelerating and expanding the use of new types of tool sets that can help us collaborate and problem solve at higher level. I think obviously all challenges can be converted into opportunities. It's more of taking the first step into investing in proof of concept, into experimenting with new technologies, into partnering with the right vendors to help you get there. And also being aware that if you don't adopt new technologies that are enablers, you might be, it might not too late, but it might be a drawback for any organization going forward.
Yeah, so while we're on the sort of challenges and risk, in fact, we have a question coming from the audience. I'll take it now because it's part of, it's in this theme that we are discussing. So one of the participants basically asked, how can we assess the risk of using blockchain in the African capital markets in the long run? So any practical sort of step-by-step processes where risk can be assessed in implementing these technologies in African capital markets. I don't know, Afak, if you have some ideas. John or Faisal, please go ahead. Just very quickly before we carry on with the discussion.
It's a difficult question because it's it's still such an experimental market, and I'm sorry I dropped off earlier when we were talking about CBDCs, but I wanted to kind of applaud Nigeria for trying to enter that market, because ultimately being the first mover means you're often the first burnt by the things that go wrong, right? So if we aren't willing to take risks, then we're not going to see the benefits, and ultimately that's what we need to do. I mean, at one point, we've said over and again about cloud technology being the norm. I mean, it wasn't a few years ago, right? That people saw it as a significant risk. There was a lot of debate about that, and in a way that we're seeing now with CBDCs. So, I think we need to take risks. I think the benefits are reasonably clear in terms of why central banks want to develop digital currencies and digital assets, and there's a desire for them in the market. It's a case of putting our best foot forward, really, and working us as vendors, helping our customers on that journey, and making sure that it's deliberative and we're achieving value as we do it. But there'll be a few missteps along the way.
Yeah, so thank you. So I'd like to really address one question, apart the last two ones, and we have to be very quick because I'm a bit worried that we are a little bit maybe near time here. So when it comes to in Africa, opportunities to use disruptive technology and using them as a force to drive growth on the continent and increase financial inclusion, how can African capital markets leverage disruptive technology specifically for inclusive growth? If you can get just one example like that, could you think that could be really, really pushing the agenda forward?
Great. So I'd like to jump into this one. This is interesting. Now, this by nature, and now we are all in sync that the disruptive technologies are indeed the way to go forward for growth. And the example you asked for, some concrete examples, is very simple, that Africa is no stranger for adopting disruptive technologies. Be it the example of mobile payment. Who was the first one? It was not the developed market, it was Africa. Kenya has put the flag in terms of the payments, the macro financing, and the mobile-based solution. Now, if the moment fintech development comes in, that leads to the inclusion. And the examples could be numerous, but to name some, that simply low fees, robo-advisory, crowdfunding, peer-to-peer communications, cloud sourcing, all of these are very simple ways. When someone was asking about blockchain, and John rightly said that it is very complex. On the contrary, these technologies are meant to grow in Africa, in parts of Asia, where the regulatory compliance are providing more fertile soil for the growth. So Salva, just to answer very briefly because of time, these are few examples that we have already seen in Africa are growing, and we see that that there is a lot of potential for using those technologies with already use cases that basically elsewhere have grown, but there is a big size. We have to see through it that how the large population in Africa can be utilized with the scalability of these technologies.
Yeah, but I also think I understand the positiveness of obviously moving forward, etc. But obviously from the survey, that one of the key points of the survey was highlighting one of the hurdles when it comes to disruptive technology is really the complexity, and I believe that came in terms of the complexity of implementation, but also very importantly, education and understanding even how do you implement those technologies, and having a greater understanding about those technologies being artificial intelligence, machine learning, etc., disruptive ledger technologies and clouds and so on and so forth. How can really the continent, or key market participants within the continent, overcome those educational challenges? I mean, are there tools out there that can support them? I mean, you know, besides having discussions like we are having today, which hopefully may shed some light to some, I mean, do you have ideas of what capital market infrastructures can do to sort of be better averse with this subject? Or, I mean,
I think it's an interesting. I mean, it's interesting because in one side we've got, you know, as we've described, you know, the digital payment system, like how that's been so like driven by Africa and the innovation that's gone on there. So when we talk about, you know, education, so actually that's been led, the market leaders there. In terms of established capital markets, I guess there's a point around education, because you know, they are taking, you know, traditional methods, traditional structures are taking more time to move along than, say, something like that with digital payments. And that's where I think us as vendors and the market need to provide better infrastructure and education, you know, certainly providing, you know, the means through which we're able to communicate with people via YouTube, giving, you know, unpacking what capital markets are, how they work. Because, you know, in developed markets in Europe and in America, we're seeing a democratization of investment, right? It's so much easier for people to access markets than it was, you know, just yesterday. I mean, I'm talking from today till yesterday. You know, there's always these things going on. So, you know, that's something that if we can start to unlock, you know, payments in Africa, that, you know, we may see the same thing there, where you see a democratization of investment, where people aren't having to go through large major institutions, but they need access to networks that they can use more media and more, you know, sort of, you know, different means of education to actually access markets. You know, and I think that's again where we have to be in support with technology. And, you know, they're not burdened by legacy technology baggage, right? And, you know, they can, to some extent, leapfrog to the latest and best tech, which is really what we're talking about here, isn't it? So, you know, it's a bit like, you know, phone networks obliviating the need to lay copper everywhere. That's kind of what we're talking about. That's why we're talking about CBDCs and digital assets and these things. So I think maybe we start to see things grow up in a way that we haven't seen in other developed markets. You know, when we think about, like, I saw a stat around private equity raising, and something like less than 1% of private equity raised globally is in Africa. You know, and that might be private capital we're talking about, and perhaps away from things like exchanges, but you know, exchange is still the most efficient way of doing it, and maybe there's somewhere in the middle where we meet and we utilize technology to unlock that, and that's where I think you can see genuine benefit in the, you know, Middle East and Africa.
Yeah, I mean, obviously there's crowdfunding, that platform out there, which could be, you know, act as a sort of alternative way to raise funding for institutions or projects, specific projects, I guess. Not sure. So we have just like literally 1 minute to close, and I wanted to ask each of you a quick question. So where do you think would be the most trendy disruptive tech in 5 years from now? Fast forward 5 years, what do you see would be right there? And yeah,
3 technologies which are, no doubt about it, we all can agree on that complexity is the real enemy, and blockchain, cloud technology, and artificial intelligence stands out, be it 5 year, be it 7 years, but these are definitely those disruptive technologies that will change the game and has the potential to revolutionize this industry, not just incremental value, but revolutionary value. And that's exactly what we basically, you know, a very case in point that this AELP program that we are part of it and being selected as the vendor to execute that. We are already having cloud computing as the cloud technology as the basis of that. We are not stalling on any site. It's over the cloud, and externalization, which is basically source of it, and digital transformation. But when, to answer your question, what in 5 to 7 years or coming future, what will be? It will be blockchain, cloud technology, and artificial intelligence.
Faisal and John, just a quick one. Which one do you think?
I mean, as critical infrastructure vendors. Sorry. Yeah. I think organizations in our industry have taken a long, proactive approach to technology and how we innovate. However, there is also the fact that there is technological convergence between different industries, right? So, I mean, the telecoms had cloud deployments way long before capital markets have been there. So we need to keep that in mind, because there might be new things that are coming up that we see that will benefit our marketplace. But I think the most important is that all organizations need to examine where they want to be 5 to 10 years from now, Selwa, and then work their way backwards to determine how to get there and what technologies will help them to get there. Cloud, definitely, it's already here, and it's definitely going to become much more overwhelming in terms of ways to deploy technology and mission-critical software to run your business. DLTs